Hi, this is Jim Curzan, and welcome to this quarter's Capital Market Review. Today we're going to talk about what happened during the first quarter of 2019. As we always do, every quarter we come up with a theme, a title for the presentation. Today I decided to title this Q1 Turnaround with a question mark. The question is, will this continue or not? We had a powerful rally in the first quarter of the year. And now that returns have exceeded most expectations for the full year, what happens from this point forward? Today, we're going to look at some economic data and try to get an understanding of just what the future might hold in store. As always, the reason we do these capital market reviews is, in our practice, the economy matters. And it's important to kind of dissect several of the major components to get a better understanding of what is actually happening. We'll focus on growth. We'll focus on job creation and the employment rate. We'll look at corporate profits, as well as take a look at inflation and the Federal Reserve and their impact on interest rates. Simply put, we do this as an attempt to answer two important questions: where we are, and more importantly, where we're heading. In our practice, the way we allocate assets has a lot to do with our opinion on two important questions. We have to have a strong opinion on these questions, and those are: where are we in the economic cycle? Are we in a recession? Are we in a recovery? Is this a mature market? We also call that a slow growth environment. Or are we in an aging market or an economic slowdown? Today, I think we're right on the cusp of slow growth as it intersects with economic slowdown. Still a ways away from a recession, but we're beginning to see some data that's beginning to show some slowdown and weakness. And then the other opinion we have to have is, where exactly is the Federal Reserve? What will they more than likely do next? Will they tighten rates or will they loosen rates? Today's agenda, we're going to look at 5 different aspects of the economy and try to answer these important questions. We'll first look at the U.S. economy and try to determine whether it's slowing or stalling, which is the risk. We'll also look at what the Fed's doing and what their next move may be. We'll look at corporate profits, and we'll look at whether or not we're actually in a profit recession at this point in time, or just maybe a year-over-year slowdown. And then we'll look globally at the economy, and we'll ask ourselves, will this thing ever revive? And then the last thing we'll do, and we'll end on this, is we'll look at some of the risks that are out there and what exactly does that mean in context of where we are today. Let's start by taking a look at the economy. Quarter over quarter, GDP growth was about 2.2%. Now that's a little bit below the expansion average of about 2.3, and actually quite a bit under the multi-year, multi-generational average of 2.7. The expectation is we'll probably see 2-ish% growth on average for the year. If we see much more than that, the consensus opinion, or I should say the consensus worry, is that we may be borrowing some growth from a forward-looking quarter. But the thought is we will see 2% growth this year, and more than likely 2% growth right up until this recovery is over. And as we'll see shortly, that may be a while yet to come. These 4 charts are really interesting. They represent certain sectors of the economy. We look at housing prices, we look at business fixed income, we look at automobile sales, and we look at the change in private inventories. Now, the reason this is important is while those 4 sectors essentially make up about 24% of GDP, they make up almost 67% of GDP's rate of change or variance in change. So you really can't have a slowdown unless you see these things turning downward and downward sharply. And we're just not seeing it. Residential real estate sales, those are slowing up a bit, as witnessed by the kind of blunting of the curve But when we look at business inventories, we look at business investment, and we even look at motor vehicle sales, they're somewhat positive to flat to positive. So this is not the cusp of a major recession or major economic setback. Also, the Fed really hasn't been overly tight. They've been raising rates now for almost 3 years. They've increased rates over that period about 2.25% in total. That's about 0.75% a year. When you consider that speed compared to other periods of time when the Federal Reserve has raised rates, the average rate increase is about 2.4% per year. That aggressiveness usually spills over into a recession. Growing rates at a rate of about 0.75% is very benign. Well, what about the employment rate? Employment is high. The unemployment rate is low. It is presently about 3.8%. But the problem now, as you can see, with any of these periods where unemployment has dropped, you can see that in 1980 or so, a big, huge drop. You can see that again in 92, again in 2002. If you look at those plunges in the unemployment rate, they kind of look like a slide. And much like a slide, it doesn't go crashing into the ground, but it's kind of fluted at the bottom of the slide and goes a bit horizontal. And we're beginning to see that form as well during this period of increased employment. And what happens is we just simply run out of unemployed workers to hire back because of either criminal activity or lack of education or training or whatever the case might be. We don't expect the unemployment rate to drop a whole lot more from where it is, but because of this lack of a pool of readily available employed, this will at some point have an effect on our economic growth. Well, what about the Federal Reserve? The market at the end of last year took off when the Federal Reserve announced that they were planning on being patient. And actually, that patience is not only being reflected in the Federal Reserve's own minutes as to what they expect to happen, but also, to an extent, what the market expects as well. If we look at the far right-hand side of the chart, you'll see all the little rate increases that we've had, which amounts to, as I said before, about 2.25% in total. And there were many of those over that 3-year period. The blue line going forward represents kind of the Federal Reserve's opinion on what they will do based on their best guess. And you'll see that rates are not going to rise a whole lot more. In fact, they're going to level off. And we're not that far away from the long-term target that they have of 2.75%. Because the Fed made the announcements they did, that they're kind of backing off a bit at the end of the year, we got a huge rally in the stock market. And we did because the market's expectation is maybe the Fed's next move will be a decrease in rates. And you see somewhat a downtrending brown line. We have no idea. If the Fed start to raise rates again more aggressively because the data looks strong, we may see the market fall here a little bit. If the Federal Reserve stays benign, we could be in this kind of soft landing, continued improvement in the recovery for a period of time. The Fed, in my opinion, has somewhat boxed themselves in a corner. If they start raising rates, the market could certainly resume the sell-off that we saw earlier 3 months or so ago, certainly through October to the end of the year. If they actually start cutting rates, we will see a huge market rally, which could create a horrible asset bubble at some point, which we'll certainly pay the price of as well. So more than likely, we're not going to see a whole lot of movement out of the Federal Reserve for the balance of the year, especially if the unemployment rate stays where it is and the inflation rate stays where it is as well. Let's talk a little bit about inflation. Right now, inflation is really pretty benign. We have an inflation rate that looks like it'll average about 2%. We don't expect the core number to go up much beyond that. And in all cases, the inflation rate today is significantly below trend line. The headline number has also dropped a bit. And part of that may be as a result of weakening real estate sales and the effect on some of real estate price points throughout the country. But generally, in this environment, the Federal Reserve can remain in a holding pattern, and this certainly is encouraging for the broad-based stock markets. Well, let's talk for a second about corporate profits. As you can see at the far right-hand side, fourth quarter of last year, we saw a drop in corporate profits. We saw a huge ramp up the prior 4 quarters, and a lot of that had to do with the passing of the Trump tax cut in the fall of 2017 and its effect in 2018. At the end of 2018, we had a significant number of companies, including Berkshire Hathaway, that elected to take large write-offs of certain assets. Some of that was tariff and trade related, some of that was not. But a lot of that happened at the end of last year. Going forward, we look at corporate profits to resume an upward trend from the fourth quarter's numbers. We think that trend will keep profit growth in the mid-single digit range, 5, 6, 7%. Now, coming off of 2018, that looks like a huge reduction. Remember, 2018 was an outlier. It had everything to do with the Trump tax cut, the effect on corporate profits, and as a result, the drive to improved corporate profits. They're simply paying less in taxes. That was a one-time wonder, and now we're resuming kind of a longer-term trend. If we see profits in the mid-single digits, those profits will be every bit as strong, if not stronger, than what we saw prior to the Trump tax cut. So as a result, we certainly don't see this causing a spillover into a recession anytime soon. Current expectations are 2020, we may very well see the same. Again, somewhat mid-single digit profit growth. That would be growth on top of 2018 and 2019's numbers. And the reason is low unemployment, low inflation, Federal Reserve that is somewhat less aggressive. All of that creates an environment where we can have more of the recovery for a somewhat longer period of time. Well, what about market valuations and the stock market itself? We just talked about corporate profits being okay. Stock market today, just about every measurement you want to look at, it ain't cheap. PEs are somewhat above long-term trend at 16.4 times earnings. When we look at dividend yield, that's about long-term average. When we look at things like the CAPE rate, that is also about average. So there aren't a lot of data points that are popping out saying, wow, this market is somewhat cheap. What I would say is from a yield perspective, if we looked at the stock market's earnings and we kind of flip that on its head and we call that a earnings yield, the earnings yield, the return you can get by investing in equities is still a fair amount higher than the interest rate you would get by investing in investment grade bonds. So at this point, the earnings yield exceeds the stock market investment grade BAA bond yield, which would mean that the market is not overbought or overly expensive. When we look at the S&P by sector, it's a mixed bag. There certainly are some sectors that from a PE perspective are really quite expensive and others that aren't. While we don't invest heavily in individual sectors, by identifying some sectors and understanding kind of where they stand in a global perspective, you might get a better idea of asset placement. Financials are interesting. They're pretty cheap. Earnings growth is pretty strong. Financials are solidly in the value camp. So one might conclude that, since value stocks are somewhat less expensive, maybe we see a shift at some point, and more interest will move toward value and out of the more expensive growth elements of the economy. Only time will tell, but that's certainly something that we think could very well happen. And it also coincides with activity you see kind of in this late stage environment. The economy's growing, it's not booming, and it may grow like this for a while. When we look at manufacturing, it's also somewhat a mixed bag. Certainly we see a whole lot more green, different shades of green on the right-hand side of the chart than we do the left-hand side of the chart. Right hand represents current period of time. Left hand represents a decade ago. It's also called a heat map. Green is good, meaning you've got a PMI number of 50% or more. 50% means expansion. Under 50 means contraction. The more contracted things get, the redder it gets. The more growth we get, the greener it gets. So we have a somewhat mixed bag. Everything looks a whole lot better than it did 10 years ago, but we don't have across-the-board expansion. I think a lot of this is tariff-related and trade talk-related. When you look at companies like Germany, clearly you're seeing a sell-off or a fall-off in manufacturing. You're seeing that also in other European countries. Conversely, we're seeing somewhat of a slight improvement in a lot of the North and Central Asian countries, Korea, Taiwan. You're seeing improvement ever so slightly. So manufacturing is a series of mini cycles. Some cycle at different rates, and you're beginning to see this. So this would be somewhat of a wait and see, but I would call that somewhat of maybe a mild negative. This can change on the dime, depending on what happens with tariff and trade talk. But we'll need to look at this and certainly compare this next quarter when we look at additional data. By the way, we look at data internally every month as it's released to us. When we look at global economic growth, we've got to remember that growth is a function of not only manufacturing, but also the service sector. And in some countries, service sector is significantly greater than manufacturing. And we're seeing that throughout. That's a longer-term trend, and it's a technology-based trend. That said, when we look at especially the left-hand side of this chart, you'll see the gray line, and you'll see that kind of dropping here, plunging a bit at the end of the chart. And you'll see the purple line, which actually has been somewhat advancing over that same period of time. The gray line represents manufacturing on a global basis, while the purple line represents global services. So it's somewhat a mixed bag. Services are still doing extremely well. Also, when we look at the global financial crisis, has it affected all companies going into it? We saw a significant drop in services and manufacturing. Looking at this, it would be hard to anticipate a global recession anytime soon with the strong service sector as it is. Well, what about the international markets as it relates to an investment theme? A couple points there. I like this chart because it certainly shows the dynamic growth that we've seen in the U.S. stock market versus the international markets. Going back to the very bottom of the trough of the Great Recession, that was March 9th, 2009, it happened that both the international markets and the U.S. market bottomed on exactly the same date. Since then, the U.S. market is up in excess of 300%. And by the way, comparing that rebound to other rebounds, it's somewhat benign. 300% is not a huge rebound over a recovery post-recession. The international markets, however, are up just over 100%. They've struggled. They've struggled with the recession. They've struggled with the sovereign debt issue. Remember Greece and Spain and the talk of Italy perhaps leaving the EU at one point or another. So when we start looking globally at what might treat money better, considering the U.S. market is maybe fully priced, you'll see the international markets are generally cheaper. Now, cheaper doesn't necessarily mean better. It could, but it is certainly cheaper. The international markets have a lower PE ratio, so you're taking less dollars to buy every unit of income or earnings. You have a much higher dividend yield, 3.5% versus 2.1%. And obviously, the other thing is just from kind of a regression toward the mean, they certainly haven't performed anywhere near the U.S. market the last decade. So maybe we'll see an upsurge following decade. Only time will tell. Let's talk about some risks for a second. Or more importantly, let's talk about the things that people talk about when they talk about risks. And one certainly is global trade. In fact, that's been in the news for a better part of a year, and depending on the news flow, news cycle, it has a major impact on the stock market. Anytime it looks like there's a deal with China or an expected deal, the market soars. Anytime it looks like there might be a problem or some type of snafu, market sells off. With respect to global trade, as it affects the U.S. market, I just want to point out something to the right-hand side. On the second half of the page, you'll see fifth bar from the bottom, the U.S., and you'll see 8%. So what does that mean? That indicates the amount that exports play as a share of GDP. Or in other words, when you look at our GDP here, only 8% of it is controlled by exports. 92% of our economy is bought and sold here within the confines of the United States. When you look at China, it's something like 15 or 19%. Clearly, trade issues affect China domestically much more than they affect the U.S., and that's one of the reasons that Trump has pursued this particular route. But when we talk about trade and we talk about improvements to trade, just remember that an improvement in the trading environment will more than likely impact and help international securities more than they might help the U.S. market for that same very reason. Another thing people talk about is corporate debt or debt levels in general. And corporate debt, as a function of all debt, has certainly been rising. And this is something to watch. On the left-hand side, you'll see three charts, one representing government debt. You'll see a huge increase in and around the financial crisis. And then a lot of zigzaggy lines the last couple of years. That's the end of quantitative easing. That's the government unraveling their balance sheet. They're continuing to do that at a relatively modest pace. In fact, they're looking at getting rid of some mortgages and replacing that with federal debt. It's kind of a way of sprucing up the balance sheet without incurring any additional debt. That is certainly can be an effective strategy. You'll look at household debt. That's the powder blue line. That's been dropping since the Great Recession. Households in the U.S. have done a great job of de-levering their debt, paying down credit cards, paying off mortgages, replacing expensive mortgages with less expensive mortgages, and as a result, kind of reducing total amount of debt, but also total amount of debt carry. Total amount of debt as a function of income is at one of the lowest points in recorded history. Much different than it was going into the last recession. That's certainly a positive. But if we look at non-financial corporates, that's generally across the board corporate debt, you'll see that's been increasing pretty steadily. Companies have been borrowing money at very inexpensive rates, and they've been using it to buy back shares of stock, which improves earnings per share, which helps shareholders, helps executives whose component of compensation is a function of share price, on and on. Once again, when we look at the revenue function that supports the debt, it's not problematic. The chart on the right-hand side at the top, BAA corporate debt. BAA is kind of the line of demarcation. We'll call that investment grade. You'll see that's about 50% of the offerings. So in other words, 50% of the offerings that are out there are less than investment grade. You can call that junk, you can call that high yield, whatever the case might be. Not a problem today, as you can see at the bottom chart on the right-hand side, upgrades to or downgrades from investment grade debt. We are seeing 3 more upgrades to every 1 downgrade. So that's still an improvement. So debt isn't going to cause a recession. The amount of high yield debt that we have could become a problem in that the more high yield debt we have, the greater the expected number of defaults, and that will have an effect on the length of time we may be in a recession. It may have some effect on the degree or drop that we have within the recession, how great the recession may be. But we're certainly not talking about anything that would look like a great recession as a result of a financial crisis, because things are really fairly healthy. The third risk that we could talk about is the budget deficit and just debt in general. It's a huge problem. At the bottom of the page on the right-hand side, you'll see federal debt. That's net debt. Continues to increase. CBO budget, CBO's forecast continues to expect it to increase as well. That's a real issue at some point. It's serviceable today as it's 77% of GDP. Consider that like one's house income. To say that your mortgage is 77% of your household income, you'd be financially in pretty good stead. For most Americans, when they secure a mortgage, they secure one that might be 3, 4, 5 times the amount of household income. So when you look at it that way, it's serviceable. But as debt continues to pile up, the percentage of debt as it relates to GDP becomes 1-to-1 or in some cases greater than 1-to-1. And then all of a sudden, a significant amount of our free cash in our economy is being used to cover debt service. That stifles economic growth. GDP certainly has a much more difficult time to grow as well. So these are issues certainly that will plague the nation unless really tough decisions about right-sizing the balance sheet and spending, but looking at testimony and looking at things that are happening today in Congress, sadly, I just don't see that happening anytime real soon. So an issue down the road, certainly not a triggering event for a recession over the next couple of years. So in a word, so far so good. Things are holding up. We don't see a recession immediately in sight. We are beginning to see data, much like housing, that's beginning to show signs of stress and beginning to slip a bit. Certainly it'll be interesting to look at what the numbers look like next quarter as they relate to this quarter and see if that was a one-off event or whether the trend continues. If it does, we follow the economics of the situation, and that would certainly cause us to make some adjustments with respect to our discretionary account management. But at this point, so far, so good. The economy's performing well, market's performing really pretty well. What a difference a year makes. If you look at 2018, which is on the far or near far right-hand side, you'll see cash was the best performing investment last year. With everything down, if you held cash or, in fact, buried money in the backyard, you did better than the broad-based market. Today, or at least year-to-date through March 31st, cash is the worst performing investment category. Other things are performing better. A asset allocation account through the end of the quarter into the first part of April, up about 9%, which jives pretty well with our model portfolios. And you'll also see that in time, over time, we're probably not going to see a whole lot of improvement in cash returns. The rate of return we're getting on cash is ridiculously low. So that'll disadvantage savers as it has in the last several years. If we have a 2% inflation rate, an increase in tax rates at some point in the future, this could be a huge problem, which advantages those who are investing in risk assets. So the idea is to keep diversified, keep global, and over time, you will see a return typically that far surpasses that of a cash alternative. So with that, I'd love to thank you for listening. If you have any questions at all, please reach out to us. And more importantly, if you know anybody, friends, family, colleagues, others that are questioning their retirement readiness, we'd love to offer a second opinion. We have several reports that we can do that with. We have a second opinion on their retirement readiness. We call that our retirement readiness report, which looks at a number of things: probability of success, asset diversification, tax efficiency. We look at the risk that we're carrying versus their risk level that they suggested through an analysis. And it will allow them to kind of focus on adjustments and modifications they might want to make, which will help them become a bit more retirement ready. As always, we follow the evolutionary wealth process. We start with the discovery interview, where we get a better understanding of clients' goals, dreams, wishes, assets, and asset location. We do some analytics between that meeting and our second, which we call our clarity meeting. At that meeting, we present our findings, we present our retirement readiness report, and in that, the client gets or potential client, I should say, gets a really clear understanding of what are some of the things that could be done to improve their situation, improve their readiness. It also provides them a really clear understanding of what it's like to work with a firm such as ours. If we're a good fit, if we can illustrate a high degree of value add, then we move on to the mutual commitment meeting, where we actually engage with this person. They become a client. And then on through our wealth management, financial planning, development steps. So again, if there's anyone out there who we can help, by all means, let us know. We are, as we always have been, open for business. Our staff is ready and willing to help anybody who kind of fits our mission statement. If you have any questions, as I said before, please reach out. You can go to our website, KaydanWealthManagement.com, and ask questions there, or you can simply pick up the phone and give us a call as well. Look forward to seeing many of you in the months ahead. Have a great spring and a wonderful summer. Talk to you soon. We will certainly touch base next quarter with the mid-year capital market review. Take care.